Morning News.
7:46 is now the time. One of the biggest debates in financial markets today is where the interest rates are headed. So here to break it all down for us is Chase Wilsey, Vice President of Wilsey Management. Chase, good morning. Glad to have you in studio.
Thanks for having me.
Yeah. Let's talk all about what is happening with interest rates right now. Give us the 411. I can never keep up.
Yeah, so I mean, there's a lot of kind of components to interest rates. Like a lot of times people talk about the Federal Reserve. Are they raising? Are they hiking interest rates? I mean, that doesn't necessarily have a direct bearing oftentimes on what's happening with the 10-year Treasury, then what's happening with mortgage rates. Kind of as a whole, though, interest rates, they have been on the rise. I think a lot of that is kind of stemming from, again, the Iran war leading to inflation fears. So we've, of course, seen a spike in mortgage rates, seen a spike in 10-year Treasury yields. We have, again, seen that rising kind of interest rate environment there.
I mean, I guess when and how can interest rates begin to drop? Because you alluded to some of the things going on, current, world affairs driving up the rates, but what about
coming down? I mean, I think part of the problem is, as a society, we've kind of become addicted to, accustomed to unrealistically low interest rates. I mean, we're not going to see, I mean, at one point...
No more 3%?
No more 3%.
Come on, Chase. I'm waiting for that 3%.
We had the 10-year Treasury fall under 1% in the post-COVID era. I mean, that's just not going to happen.
Yeah.
That's not a fair borrowing rate. So what I look at saying is we could get some reprieve, but just don't expect rates to fall off a cliff. And there's several factors that I look at that kind of lead me to believe we could see the 10-year Treasury maintain a level around 4 to 5%, unfortunately, which means mortgage rates are probably going to still be somewhere around 6 to 7%, just kind of based off statistical evidence that, there's generally going to be that spread between the 30-year fixed mortgage and the 10-year, and there's oftentimes a spread of about 2% between inflation and the 10-year Treasury as well.
Yeah, this all obviously affects so many of us, right? Affects the interest rates affect an average family. Explain some examples of how. I mean, I personally know how, but let me
I mean, the big thing is, everybody's kind of borrowing money in some fashion. Not everybody. Most people are borrowing money in some fashion, right? Whether it's an auto loan, whether it's a mortgage. I mean, the mortgage is going to be one of the most common tools that people build wealth with to buy a home. So, I mean, having higher mortgage rates, it definitely leads to affordability challenges, which is kind of another reason I do believe that home prices are not going to be spiking anytime soon. I think we're going to see this leveling off. I mean, we were seeing in post-COVID home prices accelerating about 10% a year. Yeah. That's not normal. And especially now with mortgage rates and interest rates staying higher, I think for longer, I think real estate is just kind of plateau for a while affordability catches up.
Before I ask you about how this all impacts the financial market, what is your take on credit cards that are right now being offered at like 0%? There's so many programs. You go to your bank and they're like, oh, we have, such and such credit card that is 0% interest for 12 months. Your thoughts on that? Are you hearing and seeing more and more families kind of resort to that?
They can be a great tool if utilized properly. A lot of times, you might hear that as a teaser rate, and oftentimes it can be a great way to kind of do what I call a balance transfer. If you have a high interest rate debt, let's say at 20%, you can transfer it to a 0% loan for maybe 12 months, get it paid off. That's great. Problem is, if it's 0% and you accrue this balance, and then after 12 months, now it's starting to be tacked on about a 20% interest rate.
It goes
That's
up,
where
right?
that teaser rate can really hurt people. So again, it can be a great tool for you in your financial plan, but borrowing money on a credit card is a very, very dangerous path that oftentimes is very challenging for people to get out of. So you have to be really careful with utilizing credit cards in the proper fashion.
Gotta be, very careful and diligent in trying to pay that off. Okay. And as we wrap really quick, the impact on the financial market interest rates, should we be concerned?
Generally, higher interest rates is a negative for financial markets. It kind of affects what we call the discount rate for equities. So I don't think it's going to really cause financial markets to fall off a cliff anytime soon because the 10-year staying where it is. But it is something to keep an eye on because, again, generally it is a negative to have higher rates.
Chase, always great to have you in studio, kind of breaking it down for us. Appreciate it.
Thanks for having me.
Thank you so much. We'll be right back.